Hey friends, let's talk weekly update. I'm wrong at this moment. I think I'll eventually be right over a certain amount of time. Most people are, but I think I might have been wrong about rates. Let's talk about it and I'll show you why that is. So guys, for rates, if you haven't been paying attention, they are up. So we're going to start using this website instead of Freddie Mac. Why? Because Freddie Mac it takes too long to post on Thursdays and I'm trying to get this to you guys sooner. And I really like the graph that this one has. Well, if you guys can look, and I know you can't, this isn't interactive, but on the Mortgage News Daily website, they do show that mortgage rates just 3 weeks ago at the, call it a month ago. Let's just call it a month ago. Rates were at 6.18. Now they're at 6.88. And why? That jobs report we told you guys about. So again, just to understand, by the way, that is over a half a point move in these couple of weeks. So we offer an extended lock program that we can lock for as long as 12 months. We tell folks we can't predict the future. I do think rates will eventually come down. However, this is a great example of how we can be wrong, right? I mean, I can't predict the future. I know that may shock a lot of you guys, but I can't do it. So the extended lock, people are like, oh, the rates are too high because I got to pay an extra, I'm making this up, half a point on my rate lock. Cool. Well, you just did it and you're locked in for 12 months. And now here you are playing with house money when rates go up like this. So why did that happen? Well, we can see again, back early Feb, you have the job reports that comes out the first Friday of every month. That showed 500,000 to 800,000 jobs being created. 500 is kind of like the headline number. Well, guys, I said it then, I'll say it now. I don't believe it. I think time will tell us we're right. But because of that, then you also had another number a couple of days later, or about a week later, of inflation, saying inflation wasn't coming down as aggressively as they hoped. Again, guys, I think we will be right. But right now, the market's just taking the headline news. And here's what I mean by that. A Fed president, the raging Bob Bullard, he was on CNBC and he literally said, blowout job report, unemployment's ticking down, not up. Guys, I don't believe that. So again, if you look, the graph here on the upper right shows that 517,000 jobs were created. Well, guess what? Because they were seasonally adjusted and they changed how they do these things, the seasonal adjustment, took what would have been a negative job losses of 2.5 million. But for the month of January, when they take those seasonal adjustments and how they do things, it showed $500,000 or 500,000 jobs gained. So again, I don't believe it. I think the time will tell over the next month or two. They'll show that those seasonal adjustments, when factored in and the reality comes through, is not the case. But it is interesting how a Fed member is going off the headline number saying blowout jobs report. Here's why, guys. Check this out. This is from the BLS, the Bureau of Labor and Statistics. They are the ones reporting this information in the job reports. They said December through January, there were 894,000 jobs created. Okay, that's the highlight there. But look at the middle chart. 810 of those is because of their mathematic formula and how they're basically adjusting these for seasonally for population control. So they're putting them all in 1 month for the whole year, and all of a sudden you just get this magically. The reality is only 84,000 jobs were created as opposed to the 517,000. So again, calling bull on the headline numbers. I just don't think that's true. We'll see if that comes through. And if you were to figure those numbers in, instead of having an unemployment rate of only 3.4, we should be closer to 3.9, meaning going up. That's what as much as we hate to have people lose their jobs, that's what the market needs to control inflation. When people suddenly start losing jobs, they don't ask for the raises. They don't switch to the new employer that has to overpay for them. So unfortunately, recessions do bring in job losses. And it looks like, I think we will be there in that 3.9 category in the coming months. We'll see. So in terms of inflation, shelter cost, there's a lag. We've talked about this. What's the difference between the PCE and the CPI, right? The CPI, those are two different gauges of inflation. And the PCI that's coming out, it's 40 housing shelter is 43% of the CPI. With the PCE number, it's only 18%. So they put different weight on how much people pay for rent and housing, things like that. Well, again, this is a lag. And that's why we think come May, you're going to see, I think, a really big drop in inflation in May 10th. Circle that. We've been saying it for the last couple of weeks. But look at the difference in inflation. The CPI shelter year over year shows 7.9% compared to the apartments. Apartments, again, the inflation, people aren't paying as much for their rents anymore. It's not quite as crazy as it once was, but when you factor those out, and those will come down, when that pink line gets factored into the reports that'll come out in May, again, that's why we think inflation will come down. I thought this was interesting. Because of inflation, I never thought of this, but it's absolutely true. As you guys may know, if any of you are on Social Security, there are adjustments to Social Security every year based on the cost of living. So the cost of living, also known as COLA, the adjustment, Social Security now, 70 million people, it's that, what, that fifth bullet? As of January, 70 million Americans are now getting $140 more per month, and that's ongoing. So that is inflationary. More money means more money, more money in somebody's pocket means that it could get spent. So that can be inflationary, but it's interesting. The Fed creates inflation and then they're trying to curb it, but then they give people more money. And I understand that's just how it works, but I just, thought I'd share. Here's something I thought was really interesting. So these leading economic indicators, it's a collection of indicators put together. And of the 6 times where this perfect storm had happened to where it is now has been a recession. On average, it's about 13 months later after a peak. Where we are means that March, if this holds true, if it's, stays 6 for 6, or pardon me, stays perfect, it will show that we will be in a recession, supposedly March on average. So again, we've been saying it. I think maybe we're in one. Time will tell. Here's the good news, guys. Just in time for the spring housing market. FHA and VA have both announced that it's going to be, they've lowered their insurance premiums. So for example, I know they're called different things. Technically, VA doesn't have it, but for FHA, the annual MIP, which is part of the monthly payment, is actually less. Went from 0.85 now down to about 0.75. So it's 10 basis points on that one chart. But here's the matrix. You don't need to memorize it or know it. Just know that FHA now has lower payments slightly. It's not going to be like change the world, but it's, every little bit helps. And same for VA. They're reducing what they call their funding fee. Think of it kind of like mortgage insurance, but up front, when the vet has to pay money, they've again reduced that by a few bucks. Again, not going to change the world, but it's again, every little bit helps. Existing home sales. This is the other part. I talked to somebody today. She's like, I may wait. I'm like, don't wait. Prices, as I think I told you in a previous video, they're up 7% in DFW last year. So inventory is still less than 1 million units. And this compares to 07. People think there was when the 07, 08 crash, there were 4 million homes. And by the way, there's more people now, bigger population. So we have more people now compared to 07, 08. And now there's less than 1 million. And back then there were 4 million. So that's the reason why there's still a shortage of homes. The fun stuff. Apparently, supposedly, by 2023, 40% of rental properties are going to be owned by Wall Street. I thought that was fascinating. So there's a big push, I think it's coming out of California, no shocker, that they're going to try to make it to where like only individuals can own this. It is what it is. I'll reserve my opinion on that, but I just found that amazing. Supposedly institutions may control 40% of rental homes. Somebody finally came forward and won that $1.35 billion. So good for them. I love the lottery. So it's the 4th biggest lotto. They finally admitted they come through. Now they can buy Marky Mark's house. So Marky Mark had to discount his home from 87 million to 55 million. So what a steal. Lastly, this is a shout out to my engineers. For those that don't know, I got my college degree in electrical engineering. So apparently engineering is the #1, top 10 majors, college majors for the median salaries within 5 years of graduation. I think like 8 of them are engineering. So shout out to the nerds out there. Congrats. And guys, let's get social. Be sure to share, subscribe, follow, help us out. We really appreciate it. We're working hard to increase the following. We appreciate you and hope you guys have a great rest of the week. Bye-bye.